Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, January 16th, and then we'll see how things look for Wednesday, January 17th. We had a bit of a down day. These move up, and move downs that we see now, they're less than 1%. And so we're seeing some charts that are telling kind of an interesting story. We're not really turning negative. We're still positive, but are we starting to consolidate by going sideways? That has happened before. We'll have to see if it's actually happening now. But if we end up going down below the 20-period moving averages and then closing below that, then the environment's probably going to change. But for right now, we have support underneath us at those 20-day moving averages. We also have resistance at the all-time high, which we didn't get to in Tuesday's session. So let's go back and talk about what happened. Right at the open, we did have a gap lower open. Things were negative in Europe, and that influenced the S&P futures to also be negative. We were down about 0.5% at their worst levels, and then we tried to claw our way back. By the time we opened, we did have the gap lower open and then ended up going down more than that. Prices then fell below S1 at 47.68. We fell down to support at S2 at 47.52, a very common thing. This was very mechanical, very technical. When we look at our technical analysis charts, it's very common for these pivot points to really come into play. And then we rebounded back up to the unchanged level. So we were able to fill the gap. And then it's at this point when the market decides, okay, are we going to go positive? Are we going to go back and being negative again? And that's why it's usually once the market is open for a while, that's when it decides what it wants to do. Everybody's all emotional and rah-rah about the open. Well, that can take an hour to sometimes 2 hours to work itself out, but before the market really wants to decide where it's going to head in that particular day. As the day went on, we fell back below S1 and S2. So we hit that unchanged level and then came back down. Then we rebounded slightly and closed just a little bit below S1. We were down 0.37% on above average volume. This is the first time we've seen this in a few days, even with some major economic reports coming out. We didn't really have anything major in Tuesday's session, but volume did pick up. We are positive with our technicals. We are still dealing with an overbought situation, but we have to go with this idea that maybe we're consolidating sideways. We've seen that happen before. I think it was late 2022 into early 2023, where the market was chopping sideways. There was a lot of real negativity, and everybody's thinking, yeah, the market's going to go down, going to go down. It ended up having a pretty strong up move as we worked our way into 2023. It's kind of the opposite of what we have seen so far in 2024, where we saw the end of 2023 really strong, and now at least the first week of 2024 was pretty weak, and we were able to gain some of that back. Now we're trying to figure out, where do we go from here? It's about inflation and interest rates, and that was what put pressure on stocks in Tuesday's session, was interest rates going up. We're keeping an eye on the different geopolitical events that are going on, but they don't seem to be really having an impact on the market right now. Some comments that we can make. Small caps continue to underperform. Where is this January effect? Do we call it a December effect now? Because it did last through a lot of the month of December, but it's pretty much, it can't be found. It's MIA in 2024. Rising interest rates did put a pressure on stocks. We also had the dollar going up as well. And then Fed Governor Waller came out, who is a voter, and indicated that the Fed could begin cutting rates this year. Okay, the market could have really liked that and took off. But then here comes the but. He reiterated that the Fed's estimate for 3 rate cuts, that's what they're looking at. The market is pricing in 6 rate cuts. And now they're like, okay, now we need to work our way back to reality. And so that put a little bit of pressure on the market. Mega caps and growth are showing some improvement. The mega caps are holding up. Growth was down, but it was down less than value. And so we're seeing those charts continue to show some improvement. We're still extreme positive with our stochastics chart. And intermediate term, we still have kind of a long list here with our rate of change going back 50 periods. The PMO oscillator and all of our oscillators are coming down and dropping below their moving averages, but a lot of them are still giving extreme positive readings. The Erin indicator, the bullish percent index for the S&P and NASDAQ 100, and then our new high, new low study based on the S&P. We just have the simple moving averages now with our long-term charts based on 150 periods and 200 periods. And this is the same scenario. It really hasn't changed as of right now, that there's a chance that the Fed might be done raising rates. Okay, that is looking like the most likely right now. Where we hit some variables is, are they going to cut rates? Are they going to cut rates in March? Are they going to cut rates at all? And if we start to see stronger than expected economic reports, does that mean they're going to possibly raise rates? And that produces some real uncertainty that we've been bouncing through in 2024, at least to this point. The dollar was up and interest rates were down. We got back up over that 4.02% level, where we closed at 4.07% for the 10-year yield. We still have the 10 to the 2 and the 10 to the 3 month. Those yield curves are still inverted, and they've been inverted going on 1.5 to 2 years now. Sentiment ticked down. It's still positive. We're coming in at 70 after we had been at 71. Remember, when we were really ecstatic about things, we got well into the extreme positive territory. So we're still kind of working down from that. When we start to come back down, that's when we use this as a contrarian indicator. And right now, that's just what we want to keep an eye on. Doesn't mean it's going to have to continue going down. If we turn back more positive, this still has more room to run to the upside. But for right now, it has been declining. Our trend is still positive. The green lines are on top, but we are seeing weakening trends both in the short and intermediate term. Our bias is mixed and our momentum is mixed. The market is, until we break to the upside above the all-time high or below the 20-period moving average, it's really hard to get out of this mixed environment that we're in. The economic reports, we just had the New York Empire State Manufacturing. I'm used to saying NYSE all the time. This was pretty disappointing. It just cratered. It was at a minus 43.7. The prior, I forgot the R there, it came in at minus 14.5. And I do have a chart to show you here where it really came down. This is the lowest reading that we've seen on this chart. And that doesn't bode well for the New York area. Some Isabel Net blog charts. This is what we've been seeing too. When I pointed this out every time they've been updating this chart, this is legal insider transactions. There's the illegal kind, which is if you watch the very first Wall Street movie, when Bud goes to jail at the end, that's illegal insider trading, trading on information that's not available to the public. And then there's legal insider trading, which is when people that are involved in a company, the CEO, the owners, the different officers, because they know what's going on. And if they're in there buying stock, maybe we should be buying that stock too. There are some variables in that. They may have options that they have to exercise, and there's time limits on things and different things like that. But they have to report this, but the problem is it can lag from the time they do it until it's actually reported. But what we're seeing over here on the right-hand side is a very, very high reading, meaning that there's a lot of insider buying going on right now. When it gets to a really high level like it is, that's when we use this as a contrarian indicator. But it even went up from the last reading, and that was extreme. And then we look at how are the earnings per share looking right now. And this chart actually seems to kind of contradict what the headline says. It says excluding the one-offs. These are just one company here, one company there, one time this, one time that. Consensus estimates are down only slightly more than is typical at this stage when they're reporting earnings. And that's the gold line here, where it does show that it's coming down here. And so that's why we're seeing some pressure on the market. The banks reported last Friday, and we saw them go negative. We're wondering, is that foretelling what's going to be happening as this earnings season unfolds? Are we going to see more negativity, where other times the earnings come out and it just shoots the market higher? So we're not sure if that's going to continue on for right now, or if it's going to actually change over into a more positive climate. Here's our intraday chart where we gapped lower below S1. We came down to S2, came back up, just kissed the unchanged level, chopped around a little bit, but started to head lower. Actually broke below S2 before seeing a little bit of buying and some improvement going into the close. Here's the intraday chart where we were negative in the pre-market session. And then we started to show some improvement, but then that turned more negative as we opened. And we are down about 0.25% right now. I just checked the futures before I started recording, but that's many hours before the market opens. So there's not a lot of positivity, at least carrying into the overnight session as I record this. But when you look at this, the blue is above the red here for these lines. That's meaning that growth, it was actually up when you look on an intraday basis compared to value. And we've been seeing the blue line really improve here. And so that is rather encouraging, but we need to see a continuation of this to stay more positive when looking at this type of analysis. Also, when we look at the S&P growth to value ratio, after really going down and having some problems, this is showing a lot of intraday improvement as well and actually ended up closing up. Looking at our end of day charts, growth was down for the large caps, but it was down 0.8%, where value was down a lot more. It was also down less with the mid caps as well as the small caps, almost half when you look at the mid caps and small caps. And I wanted to bring this up. The small cap growth versus value ratio, it's still going sideways, but it's getting closer to the higher end of its range, where we're actually showing some more strength here with the mid caps. And this is encouraging. We're in an uptrend and we're starting to break out above these previous highs, if that can continue, even as the index has been under pressure lately. Here is S&P growth to value. We're still in a downtrend, but we had been really going down and we're just clawing our way back and showing some improvement here. As long as this can continue, that is encouraging. And here's another growth to value chart just showing that we are still above the rainbow here when we compare growth to value. We're not breaking out yet, but we are showing some improvement. Keeping an eye on our trend, we're really dropping off with the ADX, meaning that it's not a negative trend. It just means it's a weakening trend as we're below the moving average, but we default to positive because the green line is on top, even though it is declining. Now, if we see a significant down day and the green line crosses over the red line and the red line is now on top, then we would default to negative. Here's our short term where it's also continuing to decline, but the green line is still on top. Volume picked up, but this measures over a period of a few days here. And so we're still below average when we look at our oscillator, even though for the 1-day reading, we were above average. Here's sentiment. This is one of those gauges that we look at where we take the American Association of Individual Investors, the investors' intelligence, the bullish percent index, the put call ratio, the active asset managers, the VIX, and kind of cram them all together. We're still getting a pretty extreme positive reading. But looking at our Ulcer Index, which tries to measure fear in the market, it's still below the moving average, even though with the down day, it ticked up just a little bit. We did see a bit of a turn up with the VIX on the line chart as well as the bar chart. We're starting to come back above the moving averages. And the VIX of the VIX, where we saw this go up in Friday's session, it's continuing to go up, showing the volatility is starting to increase. And the equity put call ratio, after really spiking up before CPI came out, then it fell back down. It's now going back up. So when we look at our 5-period, we're in an extreme reading right now. If we could get to a point where we have an up day that has somewhat of a convicted signal behind it, and we start to see this come down, that could be positive for the market. So the fact that we're potentially consolidating sideways after getting an extreme reading with our equity put call ratio. And I know I haven't made the case for the sideways move yet, but I'll do that as we go through here. We are picking back up just a little bit with this fear gauge, and this other fear gauge is starting to turn up. This was up a little bit when we look at our risk on to risk off ratio, but we want to see this going back up. That's just a little bit of a concern right now. With our advanced decline line, we did turn down a little bit based on price, and we're declining more based on volume. That is a warning sign where we see volume is just kind of, a little bit lower, where it shows a bit more conviction when we do look at volume. We just, again, something to be aware of there. We're pegged at the top with our 5-period moving average when we look at the new highs minus the new lows, and we continue to decline with the 10-period moving average. Another warning sign for right now. We are declining with the advanced decline ratio, but we're still above zero. Accumulation distribution did decline here, but it's still above the moving average. We're also seeing a little bit more of a drop off here with the Chaikin money flow, and the moving average continues to go down. So these are warning signs. These are things that are causing us concern. We also dropped off with the cumulative NYSE advanced decline line, and we turned down with our regular advanced decline line. We also declined with the common stock on the NYSE based on price and volume. So none of this is necessarily positive. We're also declining with our other NYSE advanced decline line that we follow. We're coming down with the common stock on the NYSE, but we're holding up a little bit better with the S&P, where we're declining more with the mid caps, and we're really declining with the small caps. We're coming back down to the moving average now. That's not what's supposed to be happening now. If you are really positive on the small caps, we're supposed to be in the January effect, and things are going in the opposite direction. Looking at our daily chart where we didn't exceed any kind of a either short-term or long-term high here, but we're still holding up for right now. Even though we were down, it wasn't that significant overall. On the bottom, volume did go above average. This hasn't changed, so just pause this and look at this. I won't read through it right now. We're no longer extreme with the 20, 50, and 200 period moving average steady. So they're coming back down now. This is encouraging. So far, at least in Tuesday's session, the simple moving average based on 20 periods, that's providing support. Then we've had other times when it's been the exponential moving average that is providing support. And as long as this holds up, that we can still maintain more of a positive stance. If we cross down below these and then close below them, that's when we would turn more negative. And our force index, even though it declined, is still above zero. And here's where we're looking extreme. We're not extreme in the short term. We're still extreme in the intermediate short term, and we're still going up in the long short term for the stochastics. And we're not extreme here. We're just into the +1 standard deviation, getting above the midpoint. So we're positive with this chart, but we're not extreme right now. And we're kind of coming down to the lower end with our double and triple exponential moving average based on 20 periods, where it's like we're hanging our legs down here below these lines. Intermediate term, we did decline, but we're still above zero with the balance of power. We're still positive with the go, no go. We're just about at the midpoint now with our highest high reading, even though this is still above the midpoint overall, and that is maintaining more of a positive posture. But we're still continuing to see the TTM squeeze drop off. It's positive, but it's a darker blue. We want to see that go back up, but there hasn't been any reason to, because prices really haven't been moving up. And we're just at the lower end here of our double exponential moving average based on 50 periods. That's the blue line where we've kind of been going in between the two. Now, these move a lot faster than our other 50 period moving averages. We turned down, but we're still positive with the ease of movement. We're turning down just a little bit with the Arun after being extreme positive. This is what I'm talking about. When you look at the McClellan oscillator for the S&P, you see how it's been declining, and we could get to an extreme negative condition here without price really doing all that much. So I saw this and I went, now I don't know if it's going to play out this way, but all we have to go with is what we're seeing right now. And the fact that this has really been coming down. Yeah, that's negative, but we're not necessarily seeing it be confirmed by price action at this point. So we are declining with the summation index based on price and volume. We're also headed lower with the NYSE McClellan oscillator. Not really close to this extreme point yet, but we could get there. So the summation index for the NYSE based on price and volume continue to decline. We're dropping below zero with the Swenlin trading oscillator based on price and volume. That's negative in the intermediate term. And we're still extreme positive with the PMO, but we're below the moving average. We're declining based on price and volume. And we're coming down. This is another one. The PMOs that are rising, yeah, that was a negative divergence, but we're really close to getting an extreme negative reading with price not really moving all that much, both with the PMOs that are rising and the buy signals. And we're still extreme positive with the PMOs that are above zero. We've turned over to neutral now with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. We're trying to turn back up with the slope oscillator, but we're still below the moving average. The MACD turned down just a little bit, but it has been trying to show some improvement, but it's still below the moving average. So with our oscillators trying to turn up with the slope, we're flattening out with the TSI, flattening out with the MACD. The PMO is still declining below the moving average. We're flattening out with the PPO. Longer term, we're still declining with the TRIX and the KST. And here is another look at the 20-period moving averages. That's a pretty critical level to be watching right now. The bullish percent index is still extreme positive, but we are declining, but we have not dropped below 70 at least yet. The NYSE bullish percent index is also declining, but still above 50. The NASDAQ 100 bullish percent index did decline, and we still have not dropped below 70. The Sean trend meter is no longer extreme after getting an extreme reading. The Chaikin oscillator turned down a little bit, but we're still above 0. The money flow dropped below 50, so that's more negative. Where the ultimate oscillator is still above 50 and advancing, that's positive. And we're coming down with the vortex with the green line, but it's still on top. We need to see that turn up. If we see a cross here, that would be more of an indication that we're turning more negative. The rate of change going back 50 periods, just hanging out here, extreme positive. And the RSI based on 14 periods turned down as well as 9 periods, but we're still above 50 with both. On balance, volume is chopping pretty much sideways, but we're still above an advancing moving average. We're coming down with our 200 period and our 50 period moving average study of those stocks in the S&P after being extreme positive. Has it worked off enough of this yet? So if we turn back around, we're not going to go extreme really fast. Of course, you could take the other side of that and say this is the beginning of a downtrend here. Here's the NYSE advanced decline line, which is dropping off as we've been holding up a little bit better based on price, and we're still in a longer-term uptrend with the NYSE advanced decline line. And then just to give you a point of reference here, this is the quadrant chart where we haven't come back to this all-time high the way I measure it here, but we're not necessarily falling apart at this point either. And we're still using this little mini rainbow as areas of support. So that continues to hold up. We're turning a little bit more negative with the Heikin Ashi with the black candle here. And we're still positive since we're black with the Kigge chart, but now we're pointing down, where the Renko chart is positive and the 3-line break continues to be positive. Then long-term with our 150 and 200 period moving averages, we're declining with both, but we're still extreme positive. And we're still above this longer-term trend line when we go when we look at a weekly chart going back to the 1987 crash. Here's something that I got from Isabel Net. This is a weekly chart just to give you a little bit of perspective. A lot of these things I try to point out as they're happening, but maybe seeing them in a little different way. You might find that useful, where we haven't quite come back to the intraday all-time high here. We're still hanging in there technically for right now. But if we see a real downward move and we start to break below support, that's really going to change things. But for right now, we're looking all right. Where we did see the equal weight index underperform the S&P, and the ratio between the S&P and the equal weight index, this is going up. That means the mega caps outperformed. This is still another concern. We're close to the all-time high with the Dow. We're actually declining with the transports and showing a pretty strong longer-term negative divergence. We also declined with utilities, which is helping the S&P a little bit. The transports are still underperforming the Dow. So I wanted to bring up this chart where you can see this is a ratio between the transports and the S&P. When this is going up, that means the transports are outperforming. Well, we're really declining. That means the transports are underperforming the S&P, and that's a bit of a concern. The Dow has pretty much been chopping sideways and got more to the lower end of its recent sideways range, where we've turned over to negative now with the Elder's Impulse system looking at the diamonds. We came down a little bit with the NASDAQ, but nothing all that scary, at least to this point. We still have this pivot level below where we're at right now. The NASDAQ 100 has pretty much been chopping sideways. We also have this pivot point below current prices. And we're continuing to be positive with the QQQs, with the Elder's Impulse system. We're trying to show some improvement here with our momentum for the NASDAQ 100, but we haven't crossed back above the moving average. The small caps. This has been an area of disappointment. This was the January effect that took us, well, partway to the moon. And now we're already coming back on the return trip and we're dropping below support and really giving a lot of those gains back. We remain negative with the small caps when looking at the Elder's Impulse system. We remain below this resistance level. We're declining with the RSI. We're declining with momentum, even though we have a longer term uptrend. The mid caps are below the pivot point now. They've been chopping more sideways, so they're holding up a little better, but they have turned over to negative with the Elder's Impulse system. The FANG index is still, it's down a little bit, 1/3%, but it's still hanging out near its all-time high. The dollar is showing some improvement. It got it back up into the 103 range after giving us a recent death cross with the trend. And we were up with the 10-year yield. We're coming back above the 200-day moving average. And this is interesting too, where we're potentially seeing a golden cross here when we look at bonds based on price for the 10-year, where we're declining with the RSI, we're declining with momentum, but the longer term trend is showing some improvement and price is above both of these moving averages. Then looking at growth to value, the Qs are still holding up when compared to the S&P, but this is another warning sign that I don't have on the list here. Discretionary is really underperforming the S&P. We want to see this going up, and it's going down, where large cap growth is outperforming large cap value. With the large caps, we're showing some improvement, mid caps, and we even saw a bit of an improvement with the small caps. So that's a little bit positive under the surface that we can hang on to. We're still extreme positive with our 10-day average of the S&P 500 highs minus the lows. We're coming down, but we're still positive here with the highs minus the lows, taking a 5-period moving average across the broad market. We're coming down just a little bit with our 50-period highs minus lows study for the S&P, but we're still well above zero. When we look at this together, the 2-year Treasury yield has been declining, even though it was up in Tuesday's session, but we have been declining, which often gives support to the S&P. And when the utilities are down, as they were, we're seeing this ratio going up, which also gives support to the S&P. And we look at the staples to S&P 500 ratio, when this is going down, that gives support to the S&P. So what's our outlook for Wednesday? Is the January effect over? Well, for right now, it sure looks that way. It doesn't mean that it won't come back. How's that for a double negative? It could come back, but for right now, it's been very frustrating for folks who wanted to play that. And we are 0 for 2 with our trifecta. We won't know the final score until the end of January. The technicals are positive, and we're still between the 20-period moving average, which is acting as support, and the all-time high, which is acting as resistance. We'll get the MBA mortgage applications index. The big one is going to be retail sales. That's a huge part of the U.S. economy. Business inventories, import and export prices. Another big one is industrial production, as well as capacity utilization, and the NAHB housing market index. And then we just want to keep an eye on these geopolitical events, but the market just isn't really doing much with these things right now. But that could always change if something big happens. On Thursday, we're going to get housing starts and building permits, and then we're going to get consumer sentiment on Friday. Seasonally, we are pretty positive when we look at January 17th. Please keep in mind that we are dealing now with options expiration week, where we tend to be down more than we are up. But for January 17th, we're neutral to positive with the Dow, where we look a lot more positive with the S&P and NASDAQ. But keep in mind, it's a Wednesday, and Wednesday is the weakest day of the week. How's that for another play on words? Where when we look at an election year, where we do tend to start off pretty choppy, and that's pretty much what's been unfolding so far. And then this is another new chart, which is comparing the Biden presidency to the 4-year cycle. And then another look at the first term presidents, and the kind of rust colored line here, maybe red, maybe maroon, whatever your choice may be. That's where we were at. But keep in mind, this is at the end of December. So this is about 2 weeks old with this chart. We will be on the 11th trading day of the month, where we do see some positive seasonality during an election year. When we look at the green dashed line, we're wondering, okay, are we in this real fall off a cliff time now for the January effect? That is supposed to come a little bit later on, maybe even into February. It seemed like it happened a little bit quicker now. And then this also confirms what we've been seeing in some other charts where we typically will start off pretty choppy during an election year. We also see that with the Stock Traders Almanac statistics. But when you have the current president running for re-election, we tend to see more positive seasonality than what we've been seeing so far. This is Wednesday, where it tends to be the more negative day of the week. So our scenario's not going with the down one. And we are still leaning more to the positive side. We're wondering, is this a sideways consolidation that's happening? We break above the all-time high, we break below the 20-period moving averages, that flies right out the window. But for right now, if we chop more sideways, then that could work off some of these extreme conditions that we've been seeing. And we're not going with the sideways right now, even though that appears to be what the market's trying to do. But our ADX charts are still above 20, suggesting that we are in a trending environment. The warning signs, the risk on posture, it's showing weakness. It was up a little bit in Tuesday's session, but we want to see more follow through than just one day. The equity put call ratio is going up in extreme. So the fact that it's going up, that's negative. The fact that it's extreme, that means that we watch it to see if it starts to turn down, and it hasn't done that yet. The transports continue to negatively diverge from the Dow. The 1 to 3 month spread is still positive where it should be negative. The Copic curve is negative. The S&P 500 oscillators are below their moving averages. Some are still extreme, but some are still looking a little bit more negative. Some are trying to flatten out a bit right now. When we look at the NASDAQ 100 momentum, it is negative, but could be showing signs of improvement, but it hasn't crossed above its moving average. The positive signs, I put growth back over on the positive slide here because we've seen a few days now, not only intraday, but end of day, where growth is outperforming value. So that is positive. Our daily special K chart is positive. Our longer term equity put call ratio is still going down overall, but with that huge spike up we saw last week, it's kind of blipping just a little bit. The parabolic SAR chart is still positive. The bullish percent index, it's still positive, but it's extreme positive, and it is coming down. The vortex is positive. The Zohar check continues to be neutral. We're still generating recent golden crosses with the Russell, the small caps, and the mid caps. Small and mid cap growth is, especially the mid caps, are showing some improvement, but more or less chopping sideways. The financial sector haven't been showing that because it's still positive for right now. But after Friday and Tuesday's session, it's showing some weakness. The new high, new low study for the S&P based on the 50-period exponential moving average study, it's still positive now. It's well above zero, but recently it has been declining. So our conclusion, we're positive and we're between the 20-period moving averages and the all-time high. Are we consolidating sideways? In the short term, that's what we're focused on right now. Intermediate term, we still have a pretty long list of overbought indicators, and we are still overbought in the long term, but we're positive because we're above the 200-period moving average. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.